Exxon Mobil. The name itself is huge, right? And the stock? Man, it's been an absolute rocket ship lately. But here's the real question. Is it flying on solid fuel or just fumes? We're gonna pop the hood, get our hands dirty, and dig right into the financials to see if this thing is a true cash-generating machine, or maybe, just maybe, a value trap in disguise. Let's get into it.
Okay, let's start with the big picture, the 5-year view. And wow, over the last 5 years, ExxonMobil has delivered a staggering, 151% return. That's not just beating the market, it's absolutely crushing the Dow Jones Industrial Average, which only did about 42%. We're talking about outperforming by nearly 3.5 times. That's just wild. So the big question is, has the business itself fundamentally changed enough to justify this massive, massive run?
And you know what gets even crazier when you zoom in? This isn't some story from a few years ago. Look at just this year. While the Dow is actually down almost 4%, Exxon is hitting the accelerator, up over 27%. It's like it's completely defying market gravity. So what on earth is going on here?
So, is this incredible performance for real? Is it built on a rock-solid foundation, or is it just, a temporary high? Well, there's really only one way to find out. We're going to open up the financial engine room and see what's really driving this thing. And hey, while we're getting started, if you enjoy these kinds of deep dives, do me a huge favor and hit that subscribe button. It really, really helps us create more of these explainers for you.
All right, first stop on our tour, inside the engine room. Our investigation starts with what I like to call the Great Operational Cleanup. This is the story of how ExxonMobil completely retooled its core business, taking it from the chaos of 2020 to where it is today.
First up, let's talk about revenue. I mean, we all remember the 2020 crash, right? Then oil prices soared and boom, a massive windfall in 2022. But that's not the most important part of this chart. The key takeaway here is the new baseline. See how even as prices have kind of normalized, Exxon has settled into this new reality of over $330 billion in annual revenue? This isn't just a recovery, folks. It's a fundamental expansion of the business. But here's the thing, it's not just about making more money, it's about making money more efficiently. They literally doubled their efficiency. Just look at their EBITDA margin. That's basically a fancy way of measuring a company's core operational profitability. It jumped from 10.5% to over 20%. This shows us they've become a much leaner, meaner operation that can handle the wild swings of the oil market way better than before.
Okay, next, let's talk about how smart they are with their money. Return on invested capital, or ROIC. This tells us how good a company is at investing its cash to make more cash. And look at this turnaround. Exxon went from actually losing money on its investments back in 2020 to generating a really healthy 10.1% return now. This is a huge deal. Why? Because it means they're no longer completely at the mercy of sky-high oil prices to be profitable. And this slide, this really illustrates the final brilliant step in the cleanup. De-risking the entire foundation of the company. It's a two-part story. On one hand, they wiped out over $24 billion in debt. Gone. And on the other hand, they added more than $100 billion in tangible assets to their balance sheet. Think about that. Less debt, more real stuff. That is an incredibly powerful combination.
Okay, so they fixed their operations, they've shored up the balance sheet, but what's the payoff? Where does all this lead? Let's move on and see exactly how this cash machine works, and, more importantly, where all that money is going. So where does all that hard work and operational efficiency lead? Right here, to the cash flow funnel. It's pretty amazing. They start with almost $52 billion coming in from just running the business. They reinvest about $28 billion of that back into the company, and what's left over? A whopping $23.6 billion in free cash flow. And just remember, free cash flow is the good stuff. It's the pure cash a company has left over after paying for everything it needs to run and grow. It's the money that can be returned directly to shareholders, like you and me. And speaking of returning money to shareholders, a huge, huge piece of that cash goes directly out as dividends. As you can see, that dividend is incredibly reliable and it's growing steadily. But, and there's always a but, right? Here's the catch. That commitment now eats up nearly 73% of all their available free cash flow. Now, don't get me wrong, it's a fantastic payout, but it definitely leaves a much smaller margin for error than they had just a few years ago. So far, the story's pretty straightforward, right? A massive, successful operational turnaround. But every good story needs a plot twist. And for Exxon, that twist is all about the future and the big strategic bets it's making, Or maybe more accurately, the bets it's not making.
This slide, right here, gets to the absolute heart of Exxon's long-term strategy. And honestly, it's a bit of a head-scratcher. It's a tale of two investments. On one side, you see them pouring billions into their traditional oil and gas business. That's the CapEx. But on the other side, their investment in R&D for new technologies is, well, it's a tiny drop in the bucket, barely anything. This is a massive all-in bet that the future of energy is going to look a whole lot like the present. It's a bold, bold strategy, and really, only time will tell if it pays off.
All right, we've looked at the turnaround, we've traced the cash flow, and we've peered into their future strategy. I think it's time to bring all the evidence together and close the case on Exxon Mobil.
At the end of the day, the numbers really don't lie. Just look at this transformation. From a $22 billion loss to a nearly $29 billion profit. From being over-leveraged to having a rock-solid balance sheet. From basically burning cash to generating over $23 billion a year. This is, without a doubt, a fundamentally different, stronger, and way more efficient company than it was just a few years ago.
So let's weigh the final evidence, the bull case versus the bear case. The bull case is super clear. You've got proven high margins, an unshakable dividend, and this amazing ability to outperform even when the market is down. The bear case, though, it points to some real risks. Free cash flow is coming down from that crazy 2022 peak, the dividend is eating up most of it, and that super low R&D spending, well, it raises some serious long-term questions. And all of that brings us to the final verdict. Hold, accumulate. Look, there is no question that Exxon, a best-in-class operator. Their efficiency is unmatched, and their balance sheet is de-risked and solid as a rock. But the market knows this. The stock is priced for that perfection. So for existing investors, this is an absolute cornerstone, a dividend hold you don't touch. But for new money, if you're looking to start a big position, you might want to be patient. Maybe wait for a broader market pullback to get a better entry price.
So that's my take. But what do you think? Is Exxon Mobil a core holding in your portfolio? Are you buying, selling, or holding? Let me know down in the comments. And more importantly, what company's engine room should we crack open next? Drop your suggestions below. I read all of them. And hey, if you found this explainer valuable, please do me a favor. Hit that like button and share it with someone who might find it useful. Thanks for tuning in.